Rivian Automotive Inc. is currently trading at exactly $15.01, up approximately $0.29 or 1.97% on this trading session as of 1:20 p.m. Eastern Time on Thursday, November 20th. The intraday chart is displaying a fascinating stair-step pattern, a methodical grind higher that stands in stark contrast to the erratic whipsaw volatility we usually associate with electric vehicle equities. After opening around $14.80, the stock found immediate buying support at the $14.90 level, refusing to break down even as the broader indices showed early morning hesitation. We are currently testing a crucial intraday resistance zone near $15.10. If the price action can reclaim and hold this level with conviction, technical models suggest a potential blue sky breakout toward the $15.50 mark by market close. The immediate expectation from the average retail investor glancing at this 2% gain is that this is just a sympathy move. They see Tesla stock or Nvidia stock rallying on broader tech optimism, and they assume Rivian is simply being dragged along for the ride by the algorithmic trading baskets. That is the expectation, a passive, leak-proof boat floating on a rising tide. The reality, however, is far more aggressive and company-specific. What we are witnessing today is the quiet accumulation of a stock that is fundamentally transitioning from a distressed startup into a critical infrastructure provider for the global automotive industry. The market is beginning to price in the massive implications of the upcoming Autonomy Day in December and the operational reality of the Volkswagen joint venture. You are not watching a stock bounce. You are watching a valuation floor being poured in concrete. Common belief suggests that Rivian is in the same death valley as Fisker or Lordstown Motors, a cash-burning furnace destined for bankruptcy or a penny stock liquidation. Investors read the headlines about slowing EV demand and assume Rivian is the next domino to fall. I want to challenge that perspective immediately. This narrative is lazy and outdated. It ignores the single most important development in the automotive world this year: the formalization of RV Tech, the joint venture with Volkswagen. Rivian is no longer just selling trucks to wealthy outdoor enthusiasts. They are effectively selling their brain, their software and zonal electrical architecture to the second-largest automaker on the planet. Today's price action is not about selling cars. It is about the market waking up to the fact that Rivian is becoming a high-margin software licensor disguised as a car manufacturer. Let's dissect the intraday volume, because it is telling a hidden story. While the headline volume is healthy, tracking for over 60 million shares, the quality of that volume is distinct. We are seeing a significant reduction in market sell orders at the bid. In previous weeks, any pop in price was met with a wall of selling from bag holders looking to exit. Today, that selling pressure is evaporating. The order book is thinning out on the ask side, meaning it takes less buying power to push the stock higher. This liquidity vacuum to the upside is a classic precursor to a short squeeze or a violent repricing event. The smart money, the institutional allocators who use interactive brokers' trading platforms and execute via dark pools, are likely stepping in to defend the $15 level, treating it as a line in the sand before the end-of-year catalysts kick in. To understand why they are buying, we have to look at the broader competitive landscape of online investment and the EV sector. The retail investor using Robinhood stock trading, or SoFi Invest, often compares Rivian directly to Tesla. But the comparison is shifting. Tesla is currently caught in a transition period between the Model Y and the Cybercab, facing aging inventory and margin compression. Rivian, conversely, is entering its product offensive cycle. The R2 platform, which is the mid-sized SUV slated for 2026, is not just a drawing on a napkin anymore. We are seeing production intent builds initiating at the Normal, Illinois facility. This means the factory lines are being retooled now. The capital expenditure, the money that they are spending that scares the novices, is actually the purchase of the machines that will print money in 18 months. Let's talk about the Volkswagen deal because the details are often misunderstood by the casual observer using fidelity brokerage apps. This isn't just a cash injection, it is a validation of Rivian's entire engineering philosophy. Volkswagen, a company with infinite resources, tried to build its own software stack, Cariad, and failed miserably. They spent billions and couldn't make it work. By turning to Rivian, they effectively admitted that Rivian's technology is superior to anything the German giant could build in-house. This $5.8 billion deal provides the runway that Bear said Rivian didn't have. It bridges the gap to the R2 launch. When you hold Rivian stock at $15, you are effectively partnering with Volkswagen, but with the upside agility of a Silicon Valley tech firm. Now, let's widen the lens to the macroeconomic environment. Today's risk-on sentiment is fueled by the belief that the Federal Reserve is done hiking rates and may look to cut in 2025. Why does this matter specifically for Rivian? Because Rivian sells expensive vehicles. The R1T and R1S average selling prices are over $70,000. These are financed purchases. When interest rates drop, the monthly payment on a Rivian drops significantly, expanding the addressable market overnight. But more importantly, the R2 is targeted at the $45,000 price point. In a lower-rate environment, that vehicle becomes accessible to the mass affluent middle class, the exact demographic that currently drives a Toyota RAV4 or a Honda CR-V. The market is forward-looking. It is buying Rivian today to front-run the rate cuts tomorrow. I want to pause here and ask you a question because this is a battleground stock. Comment below with your line in the sand for Rivian. Are you holding until the R2 launch in 2026, or are you trading these swings for short-term profit? Let me know in the comments section. Moving back to the analysis, let's discuss the software-defined vehicle (SDV) thesis. This is the buzzword you see in investment help articles, but let's break it down. Most cars today are a mess of wires, hundreds of different electronic control units, ECUs, from different suppliers that don't talk to each other. Rivian's architecture is zonal. It consolidates these into a few powerful computers. This reduces the amount of copper wire in the car by miles, literally, reducing weight and cost. But crucial to the stock thesis, it allows for over-the-air OTA updates that actually change the vehicle's behavior. This creates a recurring revenue model. When Rivian sells a subscription for autonomous driving or advanced connectivity, that is pure profit. Wall Street loves recurring revenue. They give it a higher multiple than hardware revenue. As Rivian's fleet grows, this high-margin software revenue layer begins to swell, eventually acting as a buffer against cyclical hardware sales. We also need to address the Q3 2025 earnings, which provided a mixed but ultimately bullish signal for the discerning eye. Yes, they are still losing money. The net loss was around $1.1 billion. But look at the gross profit per vehicle. It is improving dramatically. They are losing less money on every truck they build. This convergence to profitability is the metric that matters. The cost reductions from the Gen 2 platform, things like switching to in-house motors and simplifying the battery pack, are starting to show up in the financial statements. The market rewards the rate of change. As long as the losses are narrowing quarter over quarter, the stock can climb. The moment they hit gross profit positive, likely late 2025 or early 2026, the valuation framework shifts entirely, from survival to growth, potentially unlocking a doubling or tripling of the share price. Let's compare the user experience for the investor trying to play this trend. If you look at SoFi stocks or Robinhood investments, you see a lot of noise about short squeezes and gamma ramps. While those are exciting, the real money in Rivian is likely the position trade. This is where you treat the stock like a venture capital investment that happens to be liquid. Unlike Schwab Intelligent portfolios, which might allocate you a tiny sliver of the auto sector, taking a concentrated position in Rivian is a bet on a specific technological winner. It is similar to buying Apple stock in 2005. You're not buying it for the sales today, you're buying it for the ecosystem they are building for tomorrow. Technically, the stock is sitting at a pivotal juncture. The 50-day moving average is curling upward, acting as dynamic support. We are currently trading above the 200-day moving average, which is the classic definition of a long-term bull trend. The relative strength index on the daily chart is hovering in the 60 range, bullish but not overbought. This suggests